The Indian stock market is a place of immense opportunity, a dynamic arena where fortunes can be made and dreams can be realized. It's a platform where aspirations take flight and financial success stories are written every day. However, like any other financial market, it also has its dark underbelly, a shadowy side that often goes unnoticed. Scams, unfortunately, are a part of this reality, casting a long shadow over the market's potential. Understanding these scams, their mechanics, and their impact is not just about revisiting the past. It's about learning crucial lessons. It's about equipping ourselves with the knowledge to protect our present and future investments, ensuring we don't fall prey to similar traps. This essay delves into some of the most significant scams that have rocked the Indian stock market, shaking its very foundation. We'll explore the Harshad Mehta scam, the Ketan Parekh scam, the Satyam scandal, the NSEL scam, and the PMC bank fraud. Each a stark reminder of the market's vulnerabilities. Each of these events sent shockwaves through the financial system, eroding investor confidence and highlighting systemic vulnerabilities that need addressing. The stories of these scams serve as cautionary tales, reminding us of the importance of vigilance. They underscore the importance of robust regulations, ethical corporate governance, and stringent oversight mechanisms. And most importantly, they highlight the need for investor vigilance, a critical component in safeguarding investments. By understanding the modus operandi of these scams, we can learn to identify red flags and make more informed investment decisions, avoiding potential pitfalls. Ultimately, the goal is to empower ourselves as investors, to build a foundation of knowledge and awareness. We need to be able to navigate the complexities of the market with awareness and prudence, making decisions that are informed and strategic. Only then can we truly harness the potential of the stock market while safeguarding our financial well-being, ensuring a prosperous future. The year was 1992, a time of significant change and transformation. India was opening up its economy, embracing liberalization and globalization. The stock market was buzzing with activity, reflecting the newfound optimism and opportunities. It was in this climate of optimism that Harshad Mehta, a charismatic and ambitious stockbroker, orchestrated one of the most audacious scams in Indian financial history. Mehta exploited a loophole in the banking system that allowed him to obtain unsecured funds from banks, manipulating the system to his advantage. These funds were then funneled into the stock market, artificially inflating stock prices and creating an illusion of prosperity. Mehta's strategy was simple yet effective. Identify undervalued stocks, pump money into them, and create a buying frenzy. As a result, their prices skyrocketed, attracting more investors and further inflating the bubble. The scam went undetected for months, as the booming market masked Mehta's manipulations and deceit. However, the house of cards eventually collapsed, revealing the fragile foundation it was built upon. When the scam came to light, it sent shockwaves through the Bombay Stock Exchange, leading to a massive crash and widespread panic. The Harshad Mehta scam exposed the fragility and vulnerabilities of the Indian financial system. It highlighted the lack of adequate regulations and the urgent need for stricter oversight of stock market activities to protect investors. The scam also led to significant reforms in the banking and securities sectors, aimed at preventing similar events from occurring in the future, ensuring a more robust and transparent financial system. In the late 1990s and early 2000s, the Indian stock market witnessed an unprecedented boom in technology stocks. This period was marked by a frenzy of investments, with people pouring their money into tech companies, hoping to ride the wave of the digital revolution. Ketan Parekh, a chartered accountant turned stockbroker, capitalized on this frenzy, masterminding a scam that mirrored the tactics employed by Harshad Mehta. Parekh's deep understanding of the market and his connections allowed him to manipulate stock prices with ease. Parekh, often dubbed the Pied Piper of Dalal Street, formed a network of brokers and investors. This network was instrumental in executing his grand scheme, as it enabled him to control the flow of information and influence market sentiment. He used this network to manipulate the prices of a select group of stocks, primarily in the technology and media sectors. By creating an artificial demand, Parekh was able to drive up the prices of these stocks, making them appear more valuable than they actually were. These stocks, often referred to as K10 stocks, witnessed meteoric rises in their prices, driven by Parekh's manipulations. Investors, lured by the promise of high returns, flocked to buy these stocks, further inflating their prices. Like Mehta, Parekh exploited loopholes in the banking system to secure funds for his operations. He used a complex web of financial transactions to obtain the capital needed to sustain his manipulations. He used a combination of circular trading and insider trading to create an illusion of demand and drive up stock prices. This deceptive practice misled many investors into believing that these stocks were a safe and profitable investment. However, this bubble too was destined to burst. The inflated stock prices could not be sustained indefinitely, and the market eventually corrected itself. When the tech bubble burst in 2001, Parekh's empire crumbled. The sudden collapse left many investors in financial ruin as the value of their investments plummeted. The K10 stocks crashed, wiping out billions of rupees in investor wealth. The impact was devastating, with many losing their life savings in the blink of an eye. The Ketan Parekh scam once again exposed the vulnerabilities of the Indian stock market and the urgent need for stronger regulatory mechanisms. It highlighted the importance of transparency and accountability in financial markets to protect investors from such fraudulent schemes in the future. Section 4. Satyam. A chink in India's corporate armor. The Satyam scandal, which came to light in 2009, was not a case of stock market manipulation like the previous two. Instead, it was a full-blown accounting fraud that shook the very foundations of corporate governance in India. Satyam Computer Services, a global IT services company headquartered in India, was considered a poster child of India's burgeoning IT industry. However, behind this facade of success lay a web of deceit. The company's founder and chairman, Biraju Ramalinga Raju, confessed to perpetrating a massive accounting fraud. Raju admitted to inflating the company's revenues, profits, and assets for several years. This was done through a complex web of fictitious invoices, forged bank statements, and other fraudulent practices. The scam sent shockwaves through the Indian corporate world and tarnished India's image as a reliable investment destination. The Satyam scandal led to a loss of investor confidence and highlighted the critical need for stricter corporate governance norms. It also underscored the importance of independent auditors and whistleblowers in ensuring corporate accountability. Section 5. NSEL, when commodity trading turned toxic. The National Spot Exchange Limited scam, which surfaced in 2013, involved fraudulent trading in agricultural commodities. NSEL, a commodity exchange platform, offered investors the opportunity to invest in paired contracts of commodities. These contracts promised high returns and attracted a large number of investors. However, it was later revealed that most of the underlying commodities did not exist. The exchange was riddled with irregularities and fraudulent activities, with several traders colluding to defraud investors. The NSEL scam resulted in losses of thousands of crores for investors. It exposed the lack of regulatory oversight in the commodity futures market and the ease with which fraudulent activities could be carried out. The scam led to a loss of confidence in commodity exchanges and highlighted the need for more stringent regulations and greater transparency in the commodities market. It also raised questions about the role of promoters and directors of the exchange in the fraud.